Hi everyone, my name is Nicholas Merton, and today I want to spend some time to kickstart a new series here on the Data Dash channel where we focus in on specific topics that people tend not to talk about or cover in the traditional crypto media space. Being a content creator in the space, I feel that I should, to the best of my ability, give you all a behind the scenes look into what's going on in the cryptocurrency space, and along with that, give you the tools and mindset to interpret and understand what's happening in current markets. And what topic could be more valuable in understanding markets than understanding market manipulation? I stand in the belief that many people share that cryptocurrencies and blockchain technology are going to lead towards a new era of freedom for individuals across the world. But freedom without oversight can lead to some serious issues, at least in the sense of markets. Let's go ahead and spend some time today to talk about the varying levels of manipulation you can find in cryptocurrency markets. For the first few forms of manipulation we'll be discussing, I like to classify them as Category 1 manipulation. It's important to note that means of market manipulation under Category 1 tend to be more well-known or obvious to average investors and traders. Along with that as well, even though some of these methods are considered illegal under securities law, some of them are essential parts of any given market. However, they can leave dire consequences or misconceptions along with their activities. The first three forms of market manipulation we'll be discussing are pump and dumps, market makers, and algorithms. Let's go ahead and talk a little bit about what makes up a pump and dump first and foremost. Pump and dumps, or P&Ds as they're commonly referred to, tend to be the most common method of market manipulation we find in cryptocurrencies, and they pry on the weakest and smallest investors speculating on the price action of cryptocurrencies. There are a few steps that must be conducted in order to successfully execute a pump and dump. The first step has to do with gathering speculators, traders, and investors to come in all at once at a specific designated time that has been agreed upon in order to purchase up the cryptocurrency and prop up the price. This leads on to step 2, where new speculators will come in that are outside of the pump and dump group due to the recent price action that they've seen in the market with the related cryptocurrency. By bringing in new liquidity, this is giving an exit point for the pumpers to execute and sell their positions at a higher level. And as the old saying goes, what comes up must come down. As the initial investors from the pump and dump group begin to sell their position, we start to see a matching decline in price action. In some cases, this can drop the price all the way down to the initial bottom of the pump, but in some cases, it can leave it somewhere in the midway point. This shows that in most cases, new liquidity or new speculators have come in to acquire the cryptocurrency at a higher price, providing an opportunity for the initial pumpers to sell some of their cryptocurrency at a higher price. However, the sad realization comes in for the new speculators when they realize that the volume or liquidity has dried up, leaving them at the only opportunity to continue dropping their cryptocurrency as the price picks up momentum to the downside. This is just one of many daily examples that are found within the cryptocurrency space from coordinated pump and dump groups. It's important to note that pumping and dumping is not only an illegal activity in traditional and cryptocurrency markets, but along with that as well, in many cases if you participate in the pump and dump, you can end up getting burnt. In practically all cases, there is a sense of hierarchy, whereas the higher-ups are guaranteed to benefit from the activity, whereas in many cases, the bottom feeders can be used and manipulated into buying and selling later than the initial investors. The next topic we'll talk about in regards to market manipulation has to do with something known as market making. This is done by people who are known as market makers, and their job is as follows: to make a market. But to put this in simple English, this basically means that a high-level trader, someone with a lot of liquidity, or in this case a lot of Bitcoin or Ethereum, will go through and start trading a specific cryptocurrency, relatively back and forth. It's important to state that in most cases, market making isn't illegal and serves important functions in regards to any given market, especially something like cryptocurrencies. The function of a market maker is to bring liquidity into a market that isn't seeing high enough levels of volume to have steady trading or investing. The method of market making is commonly found but not limited to newly launched ICOs that hit exchange. The reason that they utilize market making is in order to bring liquidity to their newly launched cryptocurrency that might be on a limited amount of exchanges or might be experiencing the issue of having a very spread out order book, and this is where the market maker makes his profit. Not only will the market maker charge fees and commissions for the risk he's on taking with his capital, But as he continues to acquire more and more of the cryptocurrency, and as liquidity comes into the market, he will use the benefit of the spread between the bid and the ask, the bid being the price that he purchased, as well as the ask where he's going to be selling it to newcoming investors. Now, it's important to state that market makers aren't bad apples, and they're serving a functioning role within markets to make them liquid and tradable. However, at the same time, they can leave symptoms behind that give off the impression that institutional investors or larger investors are getting involved in any given cryptocurrency. So I recommend to all of you to look out for market maker volume. It's not too hard to spot most of the time, and in fact, not only does it tend to come out of nowhere with no major increase in price action, but along with that as well, the volume bars tend to be very similar on a daily basis. And last, within category 1, it's time to talk about algorithms and the difference between general trading algorithms and hyperfrequency trading. Many people still operate under the misconception that markets are generally run by human participation. However, the facts tell another story, and we can see that in traditional markets, there's been a recent dominance of algorithms or bots trading back different types of assets and currencies. And the same is going to be for cryptocurrencies, even though it still remains as a relatively human market. That doesn't mean we should ignore the unhuman aspect of it. Let's go ahead and focus in on basic trading algorithms first. Trading algorithms at their core are simply programs that have been coded in languages like Python to set an execution of an action off of certain rules or standards. We could think of this in a simple if-then scenario. If XYZ currency hits a specific price, then buy or sell. And if you continue to research just how complex you can get with building algorithms, you can start to understand why they're so important and play a massive role in modern-day markets. These algorithmic traders, very similar to that of professional day traders or swing traders, look for certain standards in the market, such as previous price history and applying a strategy of when to sell, whether it goes the way they want towards the profit zone or towards the downside, which they want to avoid at all costs. And at the end of the day, the programmer who's behind the bot hopes that he'll be able to have more winning trades than losing and provide a nice profit from the funds that he's provided to the trading algorithm. But it's important to note that algorithms offer a set of benefits that humans simply can't live up to, including the ability to cut out all emotion and follow strict rules, as well as being able to trade at a very high frequency. Speaking of high frequency trading, let's go ahead and talk about what high frequency trading really is and what its implementations on markets really are. To put it simple, high frequency trading operates much like that of the bots we were discussing earlier, off of predetermined algorithms without any human intervention. However, unlike most trading algorithms, high frequency trading puts a high emphasis not only on following a certain set of rules and objectives, but also beating others to the market at a very high frequency and speed in order to execute transactions before others. They do this in order to beat out any other high frequency traders who are trying to do the exact same thing they are. So what exactly is the objective of a high frequency trader? The main objective of a high frequency trader is to gain information on current price action as well as open orders before anyone else can. The shocking reality about all of this is that it happens within milliseconds, if not microseconds. The reason high frequency traders need to do this is in order to beat out competition who are looking for inefficiencies or opportunities within given markets. Let's go ahead through a hypothetical situation of high frequency trading inside cryptocurrency markets to get a better understanding as to how all this could look. Let's say, for example, that Bitcoin has been on the decline for the past few hours and is steadfast towards the big even level of $8,000. Across the board, most investors and traders know that at $8,000, it's not only probably a good opportunity to buy, but that most humans tend to want to buy around $8,000. Retail and institutional investors want to buy in. We have algorithms represented in the bottom right who know this, as well as the high frequency trading bots in the middle. Now, as the price drops below 8,000, there lies an opportunity to get into Bitcoin below 8,000. And as the price rebounds, we have to ask ourselves, who was the one who was able to buy in that situation? Well, it was no other than the high frequency trader, because they had the quickest connection to clock in the buy order on the exchange. This can be through a variety of different methods, whether it be location, internet connection, etc. But thanks to this higher connection, they were able to acquire Bitcoin at a lower price than other investors, thereby providing the opportunity to resell that Bitcoin within a fraction of seconds or minutes back at a higher price for a profit. Now, the profit might not seem like much at first, but given the fact that the time to execution for trade was so small and the fact that the algorithm can go about doing multiple trades throughout the day, these small profits can truly start to add up and provide a wonderful opportunity for those who can take advantage of the time delay between other participants in the market. Now, it's important to state that even though hyperfrequency trading is a controversial and powerful means of trading, that at the moment in cryptocurrency markets there isn't too much hyperfrequency trading going on, and in fact it's nowhere close to where it is in traditional markets. However, with large players like Coinbase providing low latency service to hyperfrequency traders, there is no doubt that in the next few months and years it's going to become more and more prevalent. Now that we've gone over basic forms of market manipulation like pump and dumps, as well as market participants who can lead to fluctuations in price, volume, and market orders, let's go ahead and spend some time to talk about forms of market manipulation that are less known by average traders and investors, and can lead to serious impacts on markets. In Category 2, we're going to be talking about two forms of market manipulation that are not only commonly found, but are technically illegal under US securities law. The two methods of market manipulation we're going to be discussing about are wash trading and spoofing. Let's go ahead and take a look first at wash trading and what it entails. Simply put, the method of wash trading is a form of market manipulation when an investor or two coordinated investors simultaneously sell and buy the same financial instruments to create misleading, artificial activity in the marketplace. Now, some might look at wash trading and ask how it's market manipulation and also who's to gain in the process. Well, it depends on who's doing the wash trading. It can be used for a variety of different reasons and benefits. In traditional markets, the common users of wash trading were generally brokers aiming to generate more commission fees. However, as we step into crypto markets, we see that wash trading is being used for a variety of different reasons and use cases. The biggest example of wash trading within cryptocurrencies is most likely found within the exchanges, where many have not only been caught, but many others have been accused of utilizing wash trading to push up high artificial levels of volume in order to attract investors. This is why it gets the label of wash trading, because the same exact asset is being exchanged between one individual between two different accounts or two select parties who have coordinated the wash trade, mitigating practically any risk in the process. Wash trading can also be used to manipulate price or lead to misconceptions in how a market is valuating an underlying currency or asset. A good example of this was when Bitfinex, a well-known critic of the popular exchange Bitfinex, called out an example of wash trading that was going on Kraken, which held the only USD tether to US dollar pairing for the entire cryptocurrency. So why would this be seen as wash trading? In fact, why would USD Tether want to wash trade its only dollar pair? Many would argue that whoever was conducting the wash trading was doing it in order to give off the illusion that the market was continuously evaluating USD Tether at exactly $1. But it's important to note that this isn't an anomaly in crypto markets, and that in many cases, weekly, even daily, we can spot forms of wash trading happening without any oversight or regulation on the exchanges where it's being conducted. Now that we understand what wash trading is, let's go ahead and take a look at the second form of market manipulation in Category 2, known as spoofing. The objective of spoofing can be to leave a bid or ask, or an order to buy or sell that's not meant to execute on the open exchange. Spoofing can be used in a variety of ways to lead to misconceptions or manipulation within the order book, but the most common example that we tend to see in crypto markets is when a very large investor with a lot of Bitcoin, cash, or other cryptocurrency, usually a whale by that means, goes about setting a limit or ask order that's never meant to be fulfilled. However, gives off the perception that there's a large amount of investors that are set to either buy or sell at a given price, providing a level of support or resistance in the perception of other investors. The reason why this form of market manipulation is so powerful yet so deadly at many times is because it gives us the illusion that we know what the larger players are going to do. We can obviously see their orders in the order book, right? So that means that they're going to either sell or buy at those given orders. But if the large institutional whale can't convince enough people to buy or sell before his order, and the market price is heading steadfast towards his order on the book, he can use tools such as high-frequency trading to guarantee that his order does not get fulfilled and that he can cancel it before it's too late. This instantly removes the buy or sell wall that was providing support or resistance for the underlying cryptocurrency and can leave a lot of investors burnt off of the misconception that there was institutions ready to buy or sell. Spoofing is a daily phenomenon within the cryptocurrency space. This is due to the fact that there's a lack of regulation or oversight on these exchanges, and because of this, spoofing can be found on not only a variety of exchanges, but also in a variety of cryptocurrencies outside of Bitcoin. It's important to note that the example presented earlier for spoofing is just one of many means of manipulation that spoofing can provide. Another common use case of spoofing can be to set market orders for buys or sells for Bitcoin, for example, and start to slowly cancel them out, giving the perception that people are either selling into the orders or buying into the orders. The important takeaway from all this is to take the order book with a grain of salt and understand clearly that it can be manipulated by whales and large investors to give off false perceptions in the market. That's going to be it for this episode. I'll surely be retackling the topic of market manipulation in the future, as well as some other big topics that I've promised to cover, such as the developments in OTC markets, as well as the ICO space. If you want to see a topic covered, please leave it down below in the comments. I love getting your feedback, and I'd like to know what you all think about this type of series, if you want to see more of this content, or if it's just not for you. Either way, thank you all so much for watching, and I hope you found the information that I presented as valuable and something that you can take away to become a better trader, better investor, and better spotter of market manipulation.